Today, you'll be getting a full list on where you can park your cash into. And bank interest rates are so low these days, correct? So I've actually found 8 ideas, especially if you want risk-free or low-risk ideas that you can park your cash and sleep tight on them. So in this research process, I've actually discovered some terms and conditions which I'll try to highlight with you as we explore each of these options. And today, this edition is November 2021. Some of these plans, they come and go, so do always check whether they are still available or not. And if you like such content, remember to smash the like button. So without further ado, let's roll in the intro video. Hi guys, welcome back. Now I have these 8 ideas and stay tuned to the very end because the last one is my personal favorite and I'll try to justify why also. And without further ado, let's start on the first one that you should take note of, which is the Singapore Savings Bond. Fresh out of oven, this is Singapore Savings Bond rates for November 2021. For a tenure of 1 year, you'll get an interest of 0.41%, and if you hold it for the full 10 years, the average return is 1.71%. Now, if you are not familiar with SSB, they are actually risk-free, guaranteed by government. The minimum is $500, but I always suggest don't buy just $500 because there's a $2 transaction cost. So I've actually done full tutorials before on SSB. I'll leave links below or you can check them up above. I've also taken notice of a special trend that's emerging in the SSB that I'd like to share with you now. If you look at this chart over here, the red line is actually the 1-year yield and the 10-year yield is actually depicted in the solid blue line. They have both came down, correct, over the course of the last 5 years. But what do you realize? The 1-year yield stayed low, correct? But the 10-year yield amount actually has inched up quite considerably. What does this tell you? In my opinion, this signals that the future has some inflation risk and that if you buy the Singapore Savings Bond just for a 1-year period, it really doesn't make a lot of sense. It's like 0.3 something percent. No point, correct? Doesn't move the needle, correct? If you want the Singapore Savings Bond, might as well hold it for the 10-year period. Then you get something a bit more sizable. So if 10 years is not the time frame we're looking at, then I have solutions in the next few points ahead. Second solution is actually fixed deposits. Now I've actually done the homework for you, so I want to check out all the comparison websites like MoneySmart and Value Champion. This one in particular is a screenshot from Value Champion. Pretty useful. It shows the best rates based on 1 month, 3 months, 6 months, 12 months, etc. etc. It also shows the deposit range. What I'd like to highlight in my discovery is perhaps the good ones to explore a bit further are the 2 months CIMB one, which is 0.25% and up to 100,000. But actually when they calculate out, at 0.25%, you only get like $40+ for all the effort putting that fixed deposit there. So it really is small amounts that may not move the needle for you. If you have 100,000 savings, perhaps $40+ is not what you're chasing after. If we look at 6 months, Maybank iSavvy, this can allow you to park 50,000 at 0.4%. That counts out to be about $100 after 6 months. And if we look in terms of DBS, this one is a bit more interesting. 12 months, 1.15%. That allows you to save up to $20,000 only. I want to do a deep dive into DBS. I realized also that they can allow you to do 18 months at 1.3%, but also up to $20,000. So I guess the strategy that banks are doing right now is they allow you to do higher rate fixed deposits, but they are very smart. They kept the amount a bit smaller, so they kind of acquire you as a customer, but they don't allow you to deposit big amounts. So to solve that, I actually found something by Hong Leong. This one only has a min cap of 20,000, and if you're looking for 12 months, for example, you can get 0.6%. And do check directly with them if they still have the Deepavali promotion. But all in all, I'm seeing from my private clients that they are moving away from fixed deposits. Okay, solution number 3 is actually short duration endowment plans. These endowment plans, they are fully guaranteed at maturity. But the main thing is they are first come first serve. So as of this time of filming, they are still available. As of this time you're watching, do always check the website whether they are still there or not. The first one to suggest is Etiqa's Tick Plan. This is a 3-year endowment plan that pays you 1.62% fully guaranteed at maturity. The minimum amount is $10,000 and up to $200,000. So if you don't know, Etiqa is actually a Malaysian insurer and all these plans are always fully guaranteed by SDIC. So if you're looking to buy this plan, check out my referral code. input that when you do the purchase in advance, saying a big thank you to you, and everything can be purchased online. If the tick plan is fully sold out, this plan over here could be also an alternative. The FWD 3-year 1.60% per annum, fully guaranteed at maturity also. The minimum amounts are $10,000 and up to $150,000. So this plan is actually purchased through advisors like myself. So if you're keen for $150,000 purchase, check out my email links below and let me know how I can help you a bit further. Number 4 on today's list is actually a class of products called traded endowment plans. These are endowment plans, it's just second-hand endowment plans. But it's a quick disclaimer also, MoneySense has published before that when you buy a traded endowment plan, it is not regulated by MAS. The product itself is an insurance product, it's just that this second-hand market is not regulated. In my opinion, if you are keen to dispose of your endowment plan, then these traded endowment platforms are not too bad. You can get a slightly better value than if you surrender it to the insurer itself. But if you're buying a plan from them, then do always check the guaranteed as well as the non-guaranteed amounts. I've close friends within that circle, so I won't be able to mention too deeply on details. But actually, if you Google search a bit, you can find a few brands that are doing the second-hand market. And just as an ending point, taking over policy is absolutely legal. It is just an assignment of policy itself. Number 5 on today's list is a class called yearly renewable plans. An example of it is actually the Singtel Dash Pad. This plan is actually underwritten also by Etiqa. And what does a yearly renewal plan mean? It's actually a life insurance policy that renews every year. So the insurer does have the right to change the rates according to market situation. As of now, the Singtel Dash Pad actually pays 1.3% on the first $10,000 and then only 0.3% from the 10,000 to the 30,000 mark. Max is 30,000 in the plan. And they do pay a 0.2% extra if you activate your free protection. That is why it's 1.5% in total for the first $10,000. Activating is free and you do get a free insurance cover of 50,000 and COVID-19 coverage also. Number 6 on today's list is a class of products called Robo Cash Accounts. And the one that I'm most familiar with is actually the Syfe Cash Plus. I've previously done a full tutorial, so I'll leave links below just in case you're keen about it. And in a nutshell, it has no minimum amounts, it has no lockup periods, it also has daily accrued interest. But also do note, for all Robo Cash accounts, it is not risk-free, it's not guaranteed interest because they do buy into funds where the prices do fluctuate a bit also. But the whole idea is very low risk. If you look at this chart over here, you realize that it's a slow and steady return curve. And if you look in terms of their announcement for third quarter 2021, they've actually delivered an annualized return of 1.63%, above the projected 1.5% per annum. Number 7 on today's list is actually low-risk bond funds, and the one which I featured many times on this channel before is Nikko AM Shenton Short Duration Bond. I've mentioned before this bond fund for CPF shielding is qualified for CPF OA purchase, CPF SA purchase, SRS and even for cash. And if you look at what it invests into, you realize that it buys majority to banks, correct? UOB's bonds, Maybank's bonds, National Australia Bank's bonds, Shanghai Commercial Bank's bonds. Now when we see Chinese bonds, now we kind of get a bit nervous. But also we need to take into perspective. China bond market is huge. There are ungraded bonds, there are high quality bonds also, and so not everything is risky. If you look in terms of the average credit rating, it's A-. The average weighted duration of this bond fund is 1.28 years, which means it's not sensitive to interest rate movements. If interest rates spike up, this should be relatively fine as compared to long duration bond funds. Number 8 on today's list, and before we get there, invite you to smash or subscribe, especially if you like content like this that discusses about retirement planning and investment ideas. And this, I kept it to last because I do believe that if you are trying to park cash, being too risk-free doesn't reward you too much. I'm generally quite okay on exploring and understanding the risk. But again, different investors have different needs and different approach. I'll just show you mine to let you see if you're congruent in my thinking. This is actually Tuan Sing Holdings corporate bond that will mature in 3 years' time. The yield for it is 6.9% as of issue date. And this is actually a wholesale bond, which means the minimum purchase size is $250,000. And the fun part about wholesale bonds to me is understanding the risk involved. This is actually a non-rated bond. And if you are not familiar with bond purchase, you might think, hey, how come not rated? Simply because there is a cost if you want to get a rating agency for it. So some of the smaller developers typically do not go through rating agencies. The coupon payment is semi-annual, and let's find out a bit better, and I have something prepared for you from the Bond Supermart team. Imagine that this bond is callable at a price of 102 at any time after October 2023, which is the last year of it. And when they do call at 102, it means that you are exiting at a profit. And when you buy a corporate bond, your risk is tied to a particular company. If the company goes into default, you might lose your capital. If the company goes into distress, you might see a haircut to your bond. So it's important to also understand how they are doing in terms of operations. It's also important to know how much debt they have on their books. For Tuan Sing, they have about $836 million worth of debt expiring next year. And as a developer, they usually need funds to build up projects. And they do usually issue new bonds to roll over existing ones. The total net debt to equity is 1.01 times. And the adjusted earnings before interest and taxes over interest expense stands at 1.42 times. This is typically how we gauge whether the issuer is able to repay its interest expense or not. So all in all, this bond could be attractively priced. If you are comfortable with Tuan Sing as a developer, its risk profile, then perhaps this wholesale bond could be a solution on where you can park your monies into. Mean size again is 250,000, and if you are a accredited investor looking to find a bit more, look for my links below. So hopefully I've given you a very complete overview on where you can park your cash into. It sitting in a bank account is really yielding nothing. We have discovered today fixed deposits all the way to bonds. And in case you want to further your understanding on bonds, I've actually this previous tutorial before. It explains bonds a bit better and could be a place whereby you can actually park your cash. Alternatively, if you are looking for the Syfe Cash Plus video, I'll also leave the links here so that you can follow on with that tutorial too. With that, I'll sign off from this video and see you in these. Take care and goodbye.